This is inadequate. If you purchase it at $35, your margin of safety is $15, or about 30%. Now we are beginning to approach prudent investment. The greater the margin of safety, the more room you have for error in your estimates, for unforeseen difficulties, for the general vicissitudes of business life. I learned this principle through bitter experience, as did many others, during the market collapse that began in Ichanjubat Asajul. I witnessed firsthand how securities that appeared reasonably priced based on recent earnings could and did fall to a fraction of those prices when earnings decline. Companies that seemed solid proved fragile. The investors who survived with their capital intact were those who had insisted on a substantial margin of safety, who had in effect refused to pay full price even for seemingly good businesses. The mathematics of loss and recovery underscore why protection of capital must be the investor's first concern. If you lose 50% of your capital, you must earn 100% on what remains merely to return to your starting point. A loss of 75% requires a gain of 300% for recovery. These are not theoretical concerns. I have seen investors suffer such losses, and very few ever recover from them, either financially or psychologically. Now let us discuss how the small investor can systematically identify opportunities that Wall Street, for various reasons, overlooks or undervalues. The professional investment community, despite its resources, labors under significant disadvantages. Large institutional investors cannot efficiently deploy their capital in smaller companies. A firm managing billions of dollars cannot meaningfully invest in a company with a market capitalization of 20 or 30 million. The position would be too small to affect their overall returns, and building a significant position might itself move the market price unfavorably. This creates a permanent opportunity for the intelligent small investor. Among smaller companies, particularly those that are sound but unglamorous, there often exists securities trading at prices that make no sense relative to the underlying business value. I am not speaking of exciting growth stories or popular investment themes. I am speaking of prosaic businesses, manufacturers of components, regional distributors, small utilities that perform their economic function reliably but attract little attention. The method for identifying these opportunities requires work, but it is not mysterious. You must examine financial statements with care. Look first to the balance sheet. What are the company's assets? Stated conservatively, what are its liabilities? If the net asset value per share significantly exceeds the market price, you have found something worth investigating further. But do not stop there. Assets alone can be misleading. Examine the income statement over a period of years. Are earnings consistent? Are they sufficient in relation to the price you would pay to justify your investment? A company earning $3 per share, available at $15 per share, merits careful consideration. The same company at $40 per share does not. I recall from my own experience at Graham Newman Corporation numerous instances where we purchased shares in companies for less than their net working capital alone, that is, their current assets minus all liabilities, with no value whatsoever ascribed to their plants, equipment, or ongoing business. Such opportunities were more common in the years following the Depression, but they appear even now for those patient enough to search for them. The small investor, unencumbered by the need to deploy large sums rapidly, can wait for such opportunities and act decisively when they appear. The intelligent investor must understand that market fluctuations are neither enemy nor friend. They are opportunity. This represents a complete inversion of how most people view price changes. The typical market participant rejoices when his holdings rise in price and despairs when they fall. This is natural but counterproductive. If you are a net buyer of stocks over your investment lifetime, as most young and middle-aged investors should be, declining prices benefit you. They allow you to acquire more of what you want at better prices. Rising prices benefit only those who are net sellers, the elderly drawing down capital, for instance. Consider the case of a defensive investor, someone who seeks adequate returns without substantial effort or expertise. Such an investor might establish a simple rule: maintain an equal division between high-grade bonds and a diversified portfolio of common stocks. So when stocks rise and come to represent, say, 65 or 70% of the portfolio, sell enough to restore the 50-50 balance. When stocks fall and come to represent only 35 or 40%, sell bonds and buy stocks to restore balance. This mechanical approach accomplishes something psychologically difficult but financially sound. It forces you to buy when prices are low and others are pessimistic, and to sell when prices are high and others are optimistic. Well, this strategy will not make you wealthy overnight. It will not produce spectacular returns. What it will do, practiced faithfully over decades, is provide results that are entirely adequate for most investors' needs, while protecting you from the serious mistakes that destroy capital. The defensive investor should seek not to outsmart others, but to avoid outsmarting himself. For those with the temperament and time to pursue what I call enterprising investment, a more active approach, different principles apply, but the fundamental requirement remains unchanged. You must understand what you are doing. The enterprising investor might concentrate his holdings in a smaller number of securities, but only after thorough analysis establishes a comfortable margin of safety in each. He might take advantage of Mr. Market's occasional depression to purchase at bargain prices, but he must not succumb to the siren song of speculation disguised as investment. The psychological dimension of investing deserves particular emphasis, for it is here that most investors defeat themselves. The two great psychological enemies of investment success are fear and greed, and they tend to operate in sequence. When markets are rising and stories of quick profits proliferate, greed takes hold. Investors abandon their standards, purchasing stocks they do not understand at prices that cannot be justified by sober analysis. Then, when the inevitable correction arrives, fear replaces greed. Investors sell sound securities at depressed prices, often at precisely the moment when they should be buying. I have taught at Columbia Business School for many years, and I can assure you that intelligence, as measured by academic metrics, provides no immunity against these psychological pitfalls. I have seen brilliant students capable of the most sophisticated mathematical analysis succumb to the same emotional pressures that affect the unsophisticated investor. Intelligence in investing is not about intellectual horsepower. It is about emotional discipline and realistic thinking. Let me share with you what I call the 4 most dangerous words in investing. This time is different. Every speculative mania, without exception, is accompanied by the belief that old rules no longer apply. The reasoning varies. New technology, new economic paradigms, new methods of valuation, but the theme remains constant. Old measures of value are dismissed as outdated. Those who urge caution are ridiculed as unable to grasp the new reality. And then inevitably the mania ends and the old rules reassert themselves with painful clarity. I witnessed this personally in the years leading to stocks reach valuations that could not be justified by any reasonable analysis of earning power or asset value. Yet the market continued to rise, and those of us urging caution were made to appear foolish for a time. The subsequent crash vindicated conservative principles, but at a terrible human cost. Many investors lost not just profits, but their entire capital. Some never recovered financially, others never recovered psychologically, staying out of markets entirely even when sound opportunities presented themselves years later. This illustrates another crucial point: the permanent versus the temporary in markets. Market prices are temporary. They fluctuate daily based on a complex mixture of information, emotion, and random noise. The underlying value of a sound business, by contrast, changes much more slowly and follows the business' actual performance. When you purchase a stock, you are not buying a piece of paper whose price you hope will rise. You are buying a fractional ownership in a business. If that business is sound, if it generates consistent earnings, if it maintains a strong financial position, the temporary fluctuations in its stock price are of no real consequence to you. Indeed, for the investor who understands this principle, market fluctuations become advantageous. They create opportunities to buy more of what you already own at better prices. This requires psychological fortitude, I grant you, but it is the essence of intelligent investing. The small investor's advantage here is significant. You need not explain to anyone why you are buying when others are selling. You need not justify your patience to impatient clients. Cool. Let us turn now to the specific matter of analyzing businesses, for this is the heart of security analysis. The investor must begin with financial statements, the balance sheet, income statement, and cash flow statement. These documents, properly understood, tell you the economic reality of a business. The balance sheet reveals the company's resources and obligations. The income statement shows whether the business is genuinely profitable or merely generating revenue while destroying capital. The cash flow statement, often neglected, tells you whether earnings are backed by actual cash generation or are largely accounting artifacts. When examining a balance sheet, look first at the relationship between assets and liabilities. A company with substantial debt relative to its equity is vulnerable to economic downturns and interest rate changes. During difficult times, such companies often face severe distress or bankruptcy. The investor seeking safety should generally prefer companies with minimal debt, those that could, if necessary, weather several years of poor business conditions without facing a liquidity crisis. An earnings analysis requires examining several years of history, not just the most recent year. Is the company consistently profitable, or do earnings fluctuate wildly? Wild fluctuations suggest a business model vulnerable to economic cycles or competitive pressures. Consistent earnings suggest a more stable business with perhaps some competitive advantage or protected position. Calculate the price-to-earnings ratio, but do so using average earnings over a cycle of years, not peak earnings. A stock trading at 15 times average earnings over 7 years might be reasonably priced. The same stock at 15 times peak earnings in an exceptional year is likely expensive. Book value, the accounting value of shareholders' equity, provides another useful benchmark, though it must be approached with understanding. For manufacturing companies with substantial plant and equipment, book value offers a rough measure of the capital invested in the business. If a company trades below its book value, you should ask why. Sometimes the answer is that the business is unprofitable, in which case book value is misleading. Assets that cannot generate adequate returns are worth less than their stated value. Other times, the business is sound but temporarily out of favor, and the low price relative to book value represents an opportunity. For the defensive investor, I recommend focusing on large, prominent, and conservatively financed companies. These firms, while offering limited upside in exciting markets, provide considerable safety and adequate returns over time. A portfolio of 20 to 30 such companies across different industries provides excellent diversification. The enterprising investor might dig deeper, seeking smaller or less prominent firms trading at bargain prices, but such an approach requires more extensive analysis and greater tolerance for temporary price declines. The role of bonds in a portfolio deserves careful consideration, particularly for the defensive investor. High-grade bonds provide stability and predictable income. They will not make you wealthy, but they will preserve capital during periods when stock prices are declining. The traditional approach of maintaining a balanced position between stocks and bonds, adjusting the ratio dot as prices change, provides considerable psychological comfort in addition to its financial merits. When stock prices are falling and the newspapers are filled with gloom, the bond portion of your portfolio remains stable, preventing you from feeling that all is lost and making it easier to maintain your stock position or even add to it. However, I must warn you about what bonds cannot do. They cannot protect you against inflation. A bond that pays 3% interest when inflation is 2% provides a real return of 1%. If inflation rises to 4%, that same bond produces a negative real return. Over long periods, inflation silently but relentlessly erodes the purchasing power of fixed income investments. This is why the defensive investor maintains a stock position. Stocks representing ownership in productive businesses offer some protection against inflation, as businesses can, to varying degrees, raise prices to offset increased costs. The question of diversification versus concentration is one that troubles many investors. My advice is that the defensive investor should diversify broadly, holding 20 to 30 different securities across various industries. This provides protection against the inevitable mistakes in judgment that all of us make. The enterprising investor, having conducted thorough analysis, might concentrate holdings more narrowly, perhaps 10 to 15 positions, but should never rely on a single security or even a handful of securities. The margin for error in individual security selection is too great, and the consequences of being wrong are too severe. Okay? Remember that diversification is a confession of ignorance, your own ignorance about which securities will perform best. This is not a criticism. It is a realistic acknowledgement of the limits of our knowledge. Even after thorough analysis, the future remains uncertain. Businesses face unexpected challenges. Managements make poor decisions. Economic conditions shift in unanticipated ways. Diversification protects you against these unknowable risks. I have sometimes been asked whether the small investor should attempt to time the market, to be fully invested when stocks are rising and in cash when they are falling. My answer is that for the defensive investor, such attempts are inadvisable. Successfully timing the market requires you to be right twice, when you sell and when you buy back. Most investors, even professionals, cannot do this reliably. The defensive investor should maintain a consistent policy, adjusting between stocks and bonds as their relative values change, but not attempting to predict the market's next move. The enterprising investor might, with great caution, shift the balance of his portfolio based on overall market valuation levels. When stocks generally are selling at prices far above any reasonable estimate of their intrinsic value, increasing the bond position and reducing the stock position is prudent. When stocks generally are selling at prices substantially below intrinsic value, reducing the bond position and increasing the stock position makes sense. But note that I speak of general valuation levels, not predictions about market movements. This is a subtle but critical distinction. Now, let me address a common misconception about investment returns. Many believe that achieving returns significantly above the market average is a realistic goal for anyone willing to study and work at investing. This belief is unfortunately unrealistic for most investors. If you achieve returns approximately equal to the market average, say, through a diversified portfolio of sound stocks held for the long term, you will do better than most active investors after accounting for costs and taxes. This is not a failure, it is a success. The goal is not to beat the market by large margins, but to achieve adequate returns with minimal risk of serious loss. The investor must guard against a psychological trap that I have observed countless times, the tendency to measure success by comparison with others rather than by achievement of one's own financial goals. If your portfolio grows at 8% per year while your neighbor's grows at 12%, have you failed? Only if you allow envy to cloud your judgment. The relevant question is whether your returns earned with acceptable risk are sufficient for your purposes. If they are, you have succeeded regardless of what others achieve. Now, this brings me to a fundamental truth about investing that many find uncomfortable. The relationship between risk and return is real and cannot be wished away. Higher returns require accepting higher risk. When someone promises you high returns with safety, you should be immediately skeptical. Either they do not understand the investments they are recommending, or they are being dishonest. Neither possibility should encourage you to proceed. The intelligent investor seeks adequate returns with minimal risk of permanent capital loss. Note that I say permanent capital loss, not temporary price decline. If you purchase a sound security at a reasonable price and its market price declines, you have not lost anything unless you sell. The business remains sound, its earning power remains intact, and given time, the market price will likely recover. This is why the margin of safety is so important. It provides the cushion necessary to maintain your position during inevitable periods of price decline. Throughout my decades on Wall Street, I have observed that most investment losses come not from falling prices, but from paying excessive prices in the first place. The investor who purchases a stock at 20 times peak earnings, caught up in enthusiasm about the company's prospects, courting disaster. When those peak earnings prove unsustainable, or when the market's enthusiasm wanes, the stock price may fall by half or more. The investor who insisted on a margin of safety, purchasing the same stock only when it could be had at 10 times average earnings, faces no such risk. Okay? This is why I emphasize the importance of being realistic rather than clever. The clever investor tries to predict which stocks will be market favorites, which industries will boom, which new technologies will transform the world. Sometimes he is right and earns spectacular profits. More often, he is wrong and suffers substantial losses. The realistic investor focuses on what can be known with reasonable certainty: the company's current financial position, its historical earning power, its competitive position. He does not attempt to predict the unpredictable, but instead demands a margin of safety sufficient to protect him even if things do not go as hoped. The security analyst's role, and every investor must be his own security analyst to some degree, is to distinguish between investment merit and market popularity. These are quite different things. A popular stock, widely recommended and enthusiastically purchased, often has little investment merit at its current price. An unpopular stock, widely ignored or disparaged, may have substantial investment merit. Your task is to think independently, to analyze carefully, and to maintain your standards, even when doing so makes you appear out of step with current sentiment. I have found in my teaching that students often struggle with this requirement for independent thought. They want to know what the experts think, what the consensus view is, what the smart money is doing. These are precisely the wrong questions. The right question is, given what I know about this company and its current price, does purchasing it meet my standards for investment? If it does, proceed. If it does not, wait patiently for a better opportunity. Patience is perhaps the most valuable quality an investor can possess. The market presents genuine opportunities irregularly and unpredictably. Months or even years may pass without any securities meeting your standards becoming available at acceptable prices. During these periods, the temptation to lower your standards, to justify purchases that do not truly meet your criteria, can be powerful. You must resist this temptation. Cash sitting idle, earning modest interest, may feel unproductive, but it is infinitely preferable to capital lost in ill-considered investments. As I near the conclusion of my remarks, I want to address the psychological burden that intelligent investing places upon the investor. Following the principles I have outlined requires you to act contrary to your emotional impulses at critical moments. When stocks are high and everyone is making money, you must remain cautious, perhaps even selling. When stocks are low and pessimism is pervasive, you must find the courage to buy. This is psychologically difficult, and I do not minimize the challenge, but consider the alternative. The investor who follows his emotions, who buys when he feels good about the market and sells when he feels frightened, reliably produces poor results. He purchases at high prices and sells at low prices, precisely the opposite of what produces profits. The discipline to follow sound principles, even when doing so is uncomfortable, is what separates the successful investor from the unsuccessful. The small investor's advantages, which I outlined at the beginning, mean little if not paired with this discipline. Your freedom from institutional pressures provides the opportunity to invest intelligently, but only if you exercise that freedom wisely. Your ability to wait for bargains means nothing if impatience leads you to purchase at the wrong prices. Your capacity to ignore market's mood swings benefits you only if you actually ignore them rather than being swayed by them. Let me conclude with a reflection on what endures in markets versus what is temporary. Market fashions change constantly. Industries rise and fall. Individual companies prosper and fail. What endures are fundamental economic realities that businesses have value based on what they can earn, that price and value, while often divergent in the short term, converge over time, that excessive debt creates risk, that margins of safety protect against uncertainty, that patience and discipline produce better results than cleverness and activity. These principles, which I have attempted to articulate and systematize in my work, are not my inventions. They are observations drawn from market history, distilled from decades of experience, and validated by the success of those investors who have adhered to them. They will remain valid regardless of how markets or economies change, because they are grounded in the permanent aspects of human psychology and dot economic reality rather than the temporary circumstances of any particular era. The small investor who grasps these principles, who applies them with patience and discipline, who maintains realistic expectations and guards against emotional decision making, has every reason to expect satisfactory results from his investment activities. Not spectacular results. Those who seek spectacular results must accept spectacular risks. But satisfactory results, earned with acceptable risk, providing financial security and peace of mind. This, in the end, is what intelligent investing aims to achieve, and it is well within the reach of anyone willing to apply sound principles consistently over time. Your advantages as a small investor are real and significant. The question is whether you will use them wisely or squander them in pursuit of the illusory profits that speculation seems to offer. I hope that you will choose the path of the intelligent investor, for it is the only path that reliably leads to lasting financial success.